Agora nós vamos anunciar o nosso primeiro convidado estrangeiro, que está remoto. E para falar com esse cara, eu tenho a alegria de convidar alguém que vai me ajudar a introduzir o convidado e também vai interagir com este convidado. É o Paulo Leme. Para quem não sabe, o Paulo Leme é presidente do Comitê Global de Alocação do XP Private. Ele é professor residente de finanças da Universidade de Miami e mestre em economia pela Universidade de Chicago. Bem-vindo, Paulo. Obrigado pela sua presença aqui.
Boa tarde, muito obrigado pelas boas-vindas. Boa tarde a todos que estão conectados conosco aqui no evento da XP. Realmente é um prazer imenso, especialmente poder organizar essa discussão com esse grande investidor, essa grande figura, Ray Dalio. Eu vou apresentá-lo, eu acho que todos vocês conhecem ele muito bem. Ray, I'm going to make a few brief remarks to introduce you. They're going to be in English to make things easier. So sorry for the Brazilian audience that I'm shifting languages here. But I would like to have the privilege to introduce Ray. Ray Dalio is the founder, co-chairman, and co-investment chief officer of Bridgewater. And that's one of the largest and most successful investment firms in the world, I would say. But in addition to that, I mean, he's a very prolific writer. I mean, participates in the public debate. He's a best-selling author of Principles, Life and Work, straight and to the point, very useful advice. And also writes about current global affairs in a series called The Changing World Order, in which he discusses the very complex and challenges that we face in our generation, and particularly during this coronavirus time. A little bit about Bridgewater, an amazing organization. Bridgewater was founded by Ray Dalio in 1975. I relate a lot because I come from research in Wall Street. And Bridgewater is centered around research and trading global markets. And the idea is to generate high, consistent, and diversifying returns for clients. And with a tremendous team of about 700 professionals, which is led by co-CIO Ray, Bob Prince, Greg Jensen, and they all have worked together for over 2 decades, which is really remarkable. And I think one of the fantastic things about Bridgewater, and I think I respect that a lot because I lived also in an organization with a very strong culture, is exactly the success of Bridgewater is due to its very strong and very clear culture. Relies on truthful and transparent communication to ensure the best ideas win out. In other words, a true idea meritocracy. They believe this is the secret to meaningful work and meaningful relationships, and one of the core values of Bridgewater. It is this approach that is applied to all aspects of running the firm, most importantly investments, that has basically created this amazing 45-year-long track record. Bridgewater now has always formed very long-lasting, loyal relationships with institutional investors. And XP is lucky enough to be now very closely associated with Bridgewater and working together. And I think having Ray talking to our Brazilian audience in these very challenging times, both globally, but also in Brazil in financial markets, to shed us some light. So without further ado, Ray, I would like to turn the floor to you. Ray?
Thank you very much. I'm excited to be here for the same reason most of your audience is excited to be here, because you pulled together a remarkable event, and the partnership that you referred to and the cultures that we share. The idea of not settling for anything other than excellence, this radical truthfulness and the radical transparency that you referred to, meaningful work and meaningful relationships. Anyway, I'm happy to be here and to be able to have this exchange. We have a rare relationship. We don't normally have this kind of relationship, and it's a very special relationship. So thank you very much. Well, our program is going to start off with me giving some thoughts about the markets and the world economy that we're in. And then we go to a question and answer session. So what I'd like to do is say that the experiences for me is that in my life, the times I was surprised were due to things that never happened in my lifetime before, but happened many times in history. And when I started out in the 70s, like you pointed out, I graduated from school 1973. I remember Brazil very well. I used to spend a lot of time down there. And the world has changed and shifted in many ways, but in the same things happening over and over again. And the patterns of history, but quite often they haven't happened in our lifetime before. This is now the time. There are three important dimensions in terms of factors that never happened in our lifetime before that are important. And to me, first, is there's a long-term debt cycle. And it comes in three phases. When there's an accumulation of a lot of debt and central banks try to ease monetary policy and they hit zero interest rates, lowering interest rates doesn't work anymore. And as a result, central banks print money and they buy financial assets. And that has an effect on the markets and the economy that I want to discuss and try to share with you. The second factor, it's very important in this environment, is the wealth, values, and political gaps that exist. This is true through the developed countries, and it's particularly true in the United States now. So as we'll see, those gaps are greater than at any time since the 1930 to 45 period. And the third factor is the rise of a great power in China to challenge an existing world power. And when that's happened, there is historically, it's happened 16 times in the last 500 years, there are conflicts. And those things have profound implications on investing, but they have profound implications beyond that. And those three factors, the printing of money with zero interest rates, and the distributions of money the way that it's happening today, the last time that happened was in the 1930s. It didn't happen in our lifetimes before. The last time the wealth and values and political gaps were as large as they are today was in the 1930s also. And the last time we were in a situation in which there's a rival power challenging a leading power was also in the 1930s. So I put that up on the screen, and I'd say, when I watch these things happen, and I didn't experience them before in my lifetime, it was necessary for me to study history. In other words, to understand tomorrow and to do my job well, I had to understand these things happening in the past, and they did happen in the past many times before that. So I'd like to show you a few slides and discuss these things individually because they have great bearing on what the world will look like. Because it hasn't happened, that what you're seeing has not happened before in our lifetimes, but it happened before. Let me show you the first chart. This chart, top chart, shows debt divided by GDP in the United States going back to 1900. I could show it in many countries. In many countries, it's the same thing. So what you could see in this red circle area is when debts were high. And then if you go down to the lower chart, the blue chart line shows interest rates, and you could see them hitting zero in 1933. And you could see in the chart to the right, in 2008, they came down and they hit zero. And then you could see the printing of money. This is the United States. It's a world reserve currency phenomenon. And so the printing of money and the buying of financial assets and the distributing of money right now is the most important thing in the financial markets. I want to explain it, because where does the money come from? What is its effects? Why are the markets going up? In March of 1933, President Roosevelt said, you're not going to get your gold. And then he printed money, and that was the exact bottom in the markets, March 1933. And then the stock market rose a lot in the Depression. And so that period that you had the big bear market was from 1929 to 1933 until he made that decision. That decision was the same kind of decision that was made in March of this year. That pushed up asset prices, the purchasing, because the way the markets work is that there's a lot of money, a lot of credit. When the central bank buys a bond, it gives the money to somebody who then takes that money and puts it into something else. And as a result of doing that, asset prices go up. But that money stays usually among investors. So what you see is that all investments compete with each other. And as they compete with each other, and there's more liquidity in the market, it pushes all asset prices up as all interest rates and expected returns go down and multiples expand. So if we look at interest rates, for example, we can see that what is the multiple in the United States or in other countries? They're almost close. Long-term interest rates are zero or almost close to that. That means if you give $100, it'll take almost 100 years to get your money back. And so the value of money is a very important thing. And so when you see that multiple, what is the multiple that when you buy a bond, how many times earnings does it have? It's 100 or 200 times earnings. So now equities and other assets compete with that. And so as we look at the values of equities or the values of gold, we have to look at them as storeholds of wealth, because the main thing that is happening now is the supply of money and credit is being increased greatly. Therefore, its value goes down. And those things that are storehold of wealth have their prices go up. And that has been true through history. At the same time, let me turn to the second factor, which I was describing as the wealth gap and the job employment gap chart. Okay, these charts show for the United States, but it's generally true in developed countries. it shows the net worth of the top 0.1% of the population. That's the chart on the left. It's the green line, and the bottom 90%. So you can see that in the United States, the top 0.1% of the population's net worth is nearly as much as the bottom 90% combined, which is the highest since the Great Depression. And you could see it in terms of the incomes. The income, which is the chart on the right, you could see that the incomes of the top 10% of the population are nearly as much as the top, the bottom 90%. That situation has created a political challenge, a sense that the system isn't fair, and you're seeing that manifest in the populism that you've seen. It's the reason for example, the election of Donald Trump. And that politics has market and economic implications because, for example, it's a conflict between the capitalists and the socialists. And so as you have a move to Republicans and Democrats, you have very different ideologies. If I show you the next chart, that comes across. Next chart, please. This chart goes back to 1900, and the red lines are Republicans' degree of conservatism, measured by voting records, how conservative economically they've been going back to 1900. The dashed line is the Senate, the solid line is the House of Representatives. The blue line is as how conservative or liberal, if it goes down, it's more liberal, if it goes up, it's more conservative, of the Democrats, and it shows the same thing. So that it shows that the gap, the political gap, which is the arguing over wealth gap, is the largest since, well, on record. The chart below it shows voting according to party lines. What it shows is that approximately 95% of the voting is consistent with the party. So you have a big disagreement, particularly about economics, about tax policy, and you have intransigence in that. And so that's what we're seeing, and we will see in this political environment. It has implications for the markets. It has implications for the whole world economy. For example, the taxation, tax cuts were very good for the stock market, for global stock markets, and particularly the U.S. stock market, because the tax cuts give you more money after taxes. That, if there's a change in politics, that will change taxes and will change the division of wealth. And so that conflict is economic, is political, it's social, and it's certainly market affecting. In addition, there is the rise of a great power to challenging the existing world power that has important geopolitical implications and economic implications. This chart goes back to 1500. And it is, each line represents the power of a country. Different colors represent different countries. And it's put together by a number of different measures of power. Economic power, military power, the power of the reserve currency. There are 8 different measures that make up that power. But what you can see is the blue line is the United States, and that starts around 1700. And you could see the rise of that power, particularly after the World War II period. You have to keep in mind that the world order that we're in, the system that we're in, began in 1945. That was the end of the war. And we created the dollar as the world's reserve currency. But that's very important. So the dollar is the world's reserve currency, and the dollar became the great power, and the U.S. became the great power. But that power, in various ways, is declining something, and China, which is the red line, is rising as a power in a way that didn't happen in the post-World War II period. Russia was never an important economic power. It was a comparable military power, almost, but it never was an economic power. And so we have a conflict between the United States and China, and that conflict has economic and market implications as well. It means that there are 4 wars going on. There's a trade war. There's a technology war. There's a geopolitical war. And there could be a capital war. And those things have implications on all dimensions, but certainly economic and market implications. So these are the major factors. I've been going to China since 1984, and I follow it well. And I would say it's a remarkably accomplished place. And I would say that it's an important place to realize the power of that economic system. We could discuss it in the question and answer period. So when we look ahead, just for the next year or the next 2 years, these raise important questions. For example, you will ask, what will the implications of printing all of this money around the world be? What is the value of money? What money? What currency? What is the storehold of wealth? How do I protect my wealth? What is that storehold of wealth? Related to that, and the politics and the wealth gap, we'll have an election in the United States and around the world. Who will pay the expenses? What will that mean in terms of redistributions of wealth? These will have big bearings. Tax policy will have bearings, not just in the United States, but around the world. And then the implications of China. What does the New World Order look like in terms of independence? As we are having these conflicts, it means greater self-sufficiency. The leaders of those countries recognize that there are ways that the other country could hurt it. It could be tariffs, but beyond tariffs, it could be cutting off supplies of valuable things, cutting off technologies that the others want, or things that the others want, rare earth and the like. It could mean cutting off capital. In World War II, we saw, for example, that the United States cut off the supply of oil to Japan, and it cut off its money to Japan, didn't pay its debts. These have implications for capital flows. So this is the environment that we're in. There are things that I would emphasize to take away from that. First, The power of diversification, the necessity of diversification, is of paramount importance. You know, when I first went to Brazil, this was in 1973, 74. Brazilians were very different from Argentines in that God was a Brazilian and Brazil was the boom. And of course you would invest in Brazil. Argentines at the time had experience and they had money outside the country and they diversified. And there was lessons learned about that power. Foreign exchange controls, the power of diversification. So you can diversify and reduce your risk without reducing your returns. Let me go to the next chart. Oh, well, yeah, that's the diversification chart. Yeah, I skipped what happened. Well, I'm going to go back one chart because I overlooked it. So the factors that I described in the beginning were factors that existed before the pandemic and before the economic downturn. And as I said, when you have that economic downturn and you have large wealth gaps, you tend to have conflict. So this chart shows the economic downturn that's resulting from the pandemic. And this goes back to 1900. This is world GDP decline. So we are in the deepest decline since the 1930s. That's why there's the greatest printing of money since the 1930s. That's why there's the political tensions. And so what's true for every individual, every company, and every government is that there's a certain amount of revenue. There's an income statement and a balance sheet. There's a certain amount of revenue, a certain amount of expenses, and a certain amount of savings. And if your income falls so that it's low or below your expenses, which is now happening all over the world, and there's not enough savings, there is bankruptcy, there is failure. And throughout history, that is dealt with through the printing of money and the putting the money in the hands of people and companies so that they don't fail, which is also politically expedient because those in power do a lot better by giving money out and passing the money around. But it also diminishes the value of money, and that's why it's driving asset prices up. So back to the next chart, which is the chart on diversification. The thing to know about it is there's a lot we don't know, right? And if you can reduce your risk without reducing your expected returns, it's great. And I discovered this principle, which I also call, sort of the Holy Grail. What's the Holy Grail of making money or investing? Have 10 or more, 15 good, uncorrelated investments. And I want to just explain what this chart means. Let's imagine you had an investment, to keep it simple, that had a 10% return. We could make it 10%, whatever the number is. And it had a 10% volatility to it, risk to it. And you add a second investment or a third investment. How would the risks decline? And we go to the 60, I'm showing you the 60% correlation to give you an idea. For example, the same a stock on average is 60% correlated with the other stock. So if you had a second stock and a third stock or anything that's 60% correlated, you add that, and that line shows how your risk goes down. You add 2, 3, 4, 5. You can add 1,000 investments, and if they're 60% correlated, you won't reduce your risk. Now let's imagine you have another asset that is not correlated. And that's the green line. And by the way, you can have negatively correlated assets, but let's just see the power of diversification. So if you add a second investment that also has a 10% return, expected return, you don't have 10% expected returns by way of example, but it has no correlation, you could see that after you add just 5 of those return streams, you eliminate about 60% of the risk. And if you go out to about 15, you eliminate about 80% of the risk. In the markets, it's very difficult to tell what is a better investment. And that's because all investments compete. And if it was easy to say what a better investment would be, it's just so easy to go and make money. Everybody would buy the one that's attractive and the good investment and sell the others. So diversification, assets price themselves to be competitive, and diversification is of paramount importance. Diversification of assets, diversification of countries, diversification of currencies. And so your starting position before you make tactical bets should be a well-diversified portfolio that is going to be a storehold of wealth. From that, you can make your tactical bets. But in my opinion, the key to even making your tactical bets is to make a large number of bets that are also uncorrelated, because if you make one big bet and you keep doing that, the day will come that you're going to be wrong, and it's going to be painfully wrong. So with that, I want to stop here and take your questions and pursue our discussion about what the world and markets look like. So over to you.
Just to
Hello?
continue your last topic, which I think it's quite fascinating, exactly trying to understand where we are in the world with money losing its value in terms of a store of wealth, and now equities and other assets taking that role. Obviously, I think following diversification, trying to find assets that have lower and lower correlations to build your portfolio. But I mean,